At 8:30 this morning, Jerome Powell walked into the Federal Reserve Building at Constitution Avenue in Washington, D.C., and convened the first day of what may be the last Federal Open Market Committee meeting of his career. His term as Federal Reserve Chair expires on May 15th. Kevin Warsh, the man nominated to replace him, is scheduled to clear his Senate Banking Committee confirmation vote tomorrow, April 29th, while Powell is still running the two-day meeting at which the committee will hold interest rates unchanged at 3.5 to 3.75%. The overlap is deliberate and uncomfortable. For the first time in the modern history of the Federal Reserve, an incoming chairman is being confirmed by the Senate, while the outgoing chairman is simultaneously conducting monetary policy. The markets know Powell is leaving. They know what Warsh has said publicly about the Federal Reserve's balance sheet. They know that the man who has been selected to replace the architect of the post-pandemic monetary policy framework has an explicit, stated, deeply held conviction that the Federal Reserve's balance sheet is too large, its footprint in financial markets too extensive, and its institutional credibility too compromised by what Warsh has described as mission creep beyond the central bank's core monetary mandate. They know that Warsh was Ben Bernanke's right-hand man during the 2008 financial crisis, and that, in Warsh's own words, the crisis-era tools that were supposed to be temporary have become permanent features of a system that now cannot function without them. And today, on the first day of Powell's potentially final FOMC meeting, with Warsh hours away from being confirmed and the financial system running on a balance sheet architecture that Warsh has explicitly said he wants to restructure, something specific is happening in the overnight lending market between banks that does not make any financial television headline, but is, in the plumbing of global finance, the most consequential real-time indicator of how much the institutional memory of 2008 is driving behavior in the post-Iran war, post-QT, post-pandemic financial system of April the 2026. Banks are quietly pulling back from lending to each other, not dramatically, not in the way that produces a crisis headline, but measurably, specifically, and in a pattern that every major money market analyst at every primary dealer on the street recognizes as the signature of a system approaching the edge of what liquidity economists call the ample region, the zone in which reserves are sufficient to keep rates stable, the zone below which small drains produce disproportionate rate moves, the zone the Federal Reserve spent 2 years managing a careful path toward, and, according to its own analysis published this month, just barely preserved by building a buffer of reserves ahead of the April 2026 tax season drain that the Treasury itself projected would push the Treasury General Account to a peak of approximately $1,025 billion by the end of this month. When the Treasury General Account peaks at $1 trillion, that money came from somewhere. It came from the bank accounts and money market funds of American businesses and individuals who paid their taxes in April. When it leaves private bank accounts and enters the Treasury's account at the Federal Reserve, it disappears from the reserve supply available to private financial institutions. It creates, in the technical language of money market mechanics, a reserve drain. And a reserve drain in April 2026, at the specific intersection of a Warsh confirmation vote and a Powell last meeting, and an Iran war that has pushed oil above $94, and a 30-year Treasury yield at 4.91%, and a SOFR to IORB spread that has been drifting steadily higher for months, and a Federal Reserve that just ended its $40 billion per month of Treasury bill purchases on April 15th, creates a liquidity environment that the most sophisticated money market analysts in the world are watching with more attention than they are watching the FOMC statement. By the end of this video, you are going to understand exactly what the liquidity trap is, why it is different from a credit crunch, why April 28th is precisely the worst possible day in the calendar for the specific reserve drain mechanism to be operating at full force, what the record $74.6 billion Federal Reserve standing repo program loan on December 31st, 2025, tells you about how close the system was to the edge of the ample region 6 months ago, and how much the conditions that produced that record have evolved in the intervening period, what Kevin Warsh's publicly stated balance sheet preferences mean for the specific plumbing of the financial system that the ample reserves framework has built over the past decade and a half, and why the moment of transition between Powell and Warsh is the most dangerous moment for money market stability since the September 2019 repo spike that sent overnight rates from 2% to 8% in a single day and required the Federal Reserve to pump $100 billion per day into the market to restore order. Let us start at the plumbing, because financial crises that begin in money markets always begin in the plumbing before they reach the surface. The plumbing is where you understand what is actually happening. The surface is where you find out the hard way that it already happened. The overnight funding market that most directly matters for the daily functioning of the banking system is the repo market. A repo, short for repurchase agreement, is an overnight loan collateralized by government securities. A bank that needs cash for the day sells Treasury securities to a lender in the morning with an agreement to buy them back the next morning at a slightly higher price. The difference between the sale price and the repurchase price is the effective interest rate, measured by the secured overnight financing rate, known as SOFR, which is now the benchmark rate that replaced LIBOR in the United States and which underlies approximately $220 trillion in financial contracts globally. The repo market processes approximately $1.3 trillion in tri-party general collateral transactions every single day. It is the financial system's daily heartbeat, the mechanism through which banks, money market funds, hedge funds, primary dealers, and the Federal Home Loan Banks manage the overnight allocation of cash and collateral across the entire system. When the repo market functions normally, rates are stable, cash flows smoothly, and no institution faces difficulty obtaining the overnight funding it needs to operate. When the repo market tightens, rates rise, cash becomes harder to obtain, and institutions that relied on seamless access to overnight funding discover that seamless is a description of normal times, not stressed ones. The specific stress signal in the repo market is the spread between SOFR and the interest on reserve balances rate, known as IORB, which the Federal Reserve currently pays at 3.65% to any eligible bank that holds reserve balances at the Fed. In an ample reserves environment, meaning one in which there are enough reserves in the system to meet the demand of all institutions comfortably, SOFR trades near IORB. Banks that hold excess reserves can lend them into the repo market at approximately the IORB rate, arbitraging any meaningful spread between the two. When SOFR drifts meaningfully above IORB, it signals that the supply of reserves willing to be deployed into the repo market is not meeting demand at the IORB rate. Banks are holding reserves rather than lending them because they need those reserves for their own regulatory liquidity requirements, payment obligations, or precautionary buffers. The Dallas Federal Reserve Bank published a detailed analysis in February 2026, based on data through early 2026, that identified domestic banks as what the authors called inelastic providers of marginal funding to repo markets. The specific finding is that when money market rates are above IORB, the opportunity cost of holding reserves rises, incentivizing banks to not hold more reserves than they need for their own expected liquidity needs. The result is that domestic banks, in the precise regime in which they become the marginal lenders, are inelastic suppliers of overnight liquidity. A large repo trade of $100 million would yield a bank approximately $89,000 in profit on a day when SOFR is 32 basis points above IORB, which was the largest one-day SOFR IORB spike in the 5 years prior to the Dallas Fed analysis. $89,000 is a negligible sum to a global bank. The arithmetic of short-term lending profit does not overcome the inertia of precautionary reserve holding when stress signals are accumulating. This inelasticity is the mechanism through which small reserve drains produce disproportionate rate moves. September 23, 2025, the Federal Reserve's Standing Repo Program, the Fed's permanent emergency lending facility for primary dealers and eligible banks, was tapped for approximately $18.5 billion in a single day. At that moment, it was the largest single-day draw since the facility's inception. SOFR had risen to approximately 4.42%, running well above IORB. The tightening was driven by three converging forces: large Treasury settlements, government withdrawals from bank accounts as tax flows moved into the Treasury general account, and a surge in Treasury bill issuance that increased the supply of collateral chasing available cash. The Daily Economy Analysis, published October 2025, documented this event explicitly. A chart of SOFR minus IORB over the prior 2 years showed this spread drifting steadily higher, a visual sign of creeping stress beneath otherwise orderly surface conditions. The December 31st, 2025 event was larger. On the final trading day of the year, financial institutions managing year-end balance sheet requirements and regulatory reporting created a one-day surge in demand for secured funding that pushed the Federal Reserve Bank of New York to activate its standing repo program for $74.6 billion. That figure broke the previous record of $50.35 billion set on October 31st, 2025, the prior quarter end. In a single afternoon, the most sophisticated central bank in the world provided $74.6 billion in emergency overnight loans to financial institutions that could not source that funding in the private market at acceptable rates. The collateral behind the loans was $31.5 billion in Treasury bonds and $43.1 billion in mortgage-backed securities. The loan was repaid the next morning when markets opened in 2026. The system functioned. It functioned because the Federal Reserve is the lender of last resort, and its standing facility was there to provide the liquidity the private market could not. But the specific sequence of events tells you something about the state of the plumbing. Record SRF draw at October 31st, quarter end. New record SRF draw at December 31st, year end. A September tightening so acute that SOFR printed 18 basis points above IRB. A Fed that ended its quantitative tightening on December 1st, 2025, and announced reserve management purchases of $40 billion per month in Treasury bills on December 10th, precisely to stabilize the reserve conditions that the September and October and December stress events had revealed were narrower than comfortable. And then the Fed ran those reserve management purchases through April 15th, 2026, when it stopped. April 15th, 2026, 13 days ago, the day the Fed stopped buying $40 billion per month of Treasury bills to maintain ample reserves. And today is April 28th, in the heart of the April tax season drain, with the Treasury General Account approaching its projected peak of approximately $1,025 billion, which represents the largest single drawdown of reserves from the private banking system in the annual calendar. The Fed built a reserve buffer specifically to absorb this drain. The Dallas Fed analysis published April 2, 2026, confirmed this explicitly. The Federal Open Market Committee judged that reserves had declined to the ample level in December 2025 and began reserve management purchases to preserve that level. The FOMC built a buffer of reserves in anticipation of the April 2026 tax season drain. Reserves fluctuated in a range of more than $200 billion in the period from early December to April. That buffer is now being consumed. Every dollar that flows from a private bank account into the Treasury General Account during April tax payments reduces the reserve supply available to the private banking system. The Treasury itself projected the TGA would peak at approximately $1,025 billion, plus or minus $50 billion by late April. If the TGA is near $1 trillion today, and bank reserves stood at approximately $3 trillion as of the most recent Federal Reserve balance sheet data, the April tax drain has potentially consumed $200 billion or more in reserves since the RMP purchases ended on April 15th. The specific question that every money market risk manager is calculating today, on April 28th, the first day of the FOMC meeting, is how much of the buffer remains and whether the system is still comfortably in the ample region or whether it is approaching the boundary at which SOFR begins to drift above IORB in ways that require intervention. The answer matters enormously for what happens at the FOMC meeting that just began this morning, because the FOMC meeting itself creates a specific and well-documented anomaly in money market rates. During FOMC meeting weeks, primary dealers, the 18 institutions that are required to participate in Treasury auctions and to make markets in government securities, adjust their financing positions. Uncertainty about the rate decision, even when the decision is nearly certain to be a hold as it is this week, creates demand for short-term liquidity management that does not exist on non-FOMC days. Rates in the federal funds market and the repo market historically show modest but measurable elevation during FOMC meeting days compared to surrounding days, driven precisely by the institutional positioning that occurs when the policy rate is about to be officially reset. An FOMC meeting week on top of the April tax drain on top of the RMP purchases, having ended 13 days ago on top of a Warsh confirmation vote tomorrow, is not individually a crisis. Each element is manageable. Together, they represent the most concentrated set of liquidity-relevant events in a single two-day window since the December 31st year-end that produced the $74.6 billion SRF record. Now let us look at Warsh, because understanding what happens after April 29th changes the structural calculation for every money market participant modeling the next 12 months. Kevin Warsh was confirmed by the Senate Banking Committee tomorrow, April 29th, by the most current reporting available as of this morning. His full Senate confirmation vote is expected to follow within days. He assumes the Fed chair position on May 15th. He will chair his first FOMC meeting in June. Warsh's publicly stated position on the Federal Reserve's balance sheet is the most consequential variable in money market analysis for the next 12 months, more consequential than the March inflation data, more consequential than the Iran war ceasefire progress, more consequential than any single GDP print. He has said in various forums that the Federal Reserve's balance sheet should be smaller, its footprint in financial markets should be reduced, and its role as a de facto market maker of last resort in Treasury market stress events should be circumscribed. Goldman Sachs Asset Management analyzed his position in a March 2026 research note and concluded that while balance sheet reduction under Warsh would require committee buy-in, regulatory approval, and time, the direction of travel was clear, and the market should price some probability of renewed quantitative tightening under the new chair. PIMCO's macro analysis, published April 1, 2026, offered a different perspective. It argued that reducing reserve demand by changing liquidity regulations, specifically by allowing large banks to assume use of the Fed's discount window and standing repo program in their stress test scenarios rather than holding reserves to self-insure against GFC-like events, would be more efficient than balance sheet reduction itself. If banks are allowed to hold fewer reserves because they can rely on the Fed's standing facilities, the actual required level of reserves in the system decreases, effectively shrinking the balance sheet's practical footprint without necessarily reducing its nominal size. PIMCO described this change as potentially coming from regulators as soon as later this year, taking effect as early as January or April of next year. The specific implication for money market participants today is that the transition from Powell to Warsh introduces a period of genuine uncertainty about the Fed's operating framework at exactly the moment when the reserve buffer built for the April tax strain is being consumed. When reserves are ample and the framework is stable, money market participants know the rules. They know SOFR will trade near IORB. They know the SRF is available as backstop. They know the Fed will conduct open market operations if rates deviate materially from target. They know the rules because Powell has been implementing them consistently since the ample reserves framework was formalized after the September 2019 repo crisis. Under Warsh, those specific rules may be rewritten. The direction of the rewriting towards smaller balance sheet and reduced standing facilities is the direction that, if implemented without adequate transition, produces exactly the kind of funding stress that September 2019 demonstrated. September 2019 is the specific historical event that money market practitioners use as their worst-case reference point for what happens when the Fed misjudges the ample level. On September 16, 2019, SOFR spiked from approximately 2.2% to 5.25%, an increase of more than 300 basis points in a single day. Repo rates for some transactions printed above 9%. The cause was a simultaneous occurrence of corporate tax payments, a large Treasury auction settlement, and a reduction in bank reserve supply that pushed the system below the ample level faster than the Fed anticipated. The Fed intervened with up to $100 billion per day in overnight repo operations and resumed permanent open market operations to restore reserve levels. The episode lasted several weeks before fully normalizing. The conditions of September 2026 are not identical to September 2019. Bank reserves today are approximately $3 trillion, substantially above the pre-crisis levels of September 2019 when they had fallen to approximately $1.5 trillion. The SRF exists now and did not exist then. The overnight reverse repurchase facility provides a floor. The architecture of the ample reserves framework is more robust than what existed in 2019, but the structural pressures operating on that architecture are also more complex than they were in 2019. The stablecoin disintermediation effect documented by the Federal Reserve Bank of New York research published in early 2026 found that banks holding stablecoin deposits, responding rationally to the at-par redemption design of stablecoins, hold more reserves and reduce relative lending activities. The paper estimated a drop of approximately 14 percentage points in the studied bank's loan-to-asset ratio relative to peers. When banks hold more reserves and lend less as a result of stablecoin deposit management, the effective demand for reserves in the system is higher than the headline reserve balance suggests, because some portion of those reserves is functionally unavailable for lending into overnight markets. The Financial Stability Board's February 4, 2026 report on vulnerabilities in government bond-backed repo markets identified three structural features of the current repo market that create systemic fragility. First, demand and supply imbalances in repo markets can arise quickly in stress periods. When volatility spikes, cash borrowers need additional liquidity for margin calls, while cash lenders may be unable or unwilling to provide funding in stress. Second, repo markets are highly concentrated, with central nodes including central counterparties and custodians. Concentration within cash borrowers, cash lenders, and intermediaries increases the probability that operational failures, financial distress, or capacity constraints in key market participants disrupt market activity. Third, approximately 70% of non-centrally cleared repo transactions operate with zero haircuts, meaning lenders hold no cushion against the value of the collateral declining. When collateral values fall, as they did when Treasury yields spiked during the basis trade unwind documented in March 2026, the zero haircut transactions leave cash lenders with full exposure to collateral depreciation. The basis trade element connects directly to the Fed's balance sheet dynamics in the way that completes the circle. The basis trade involves hedge funds buying cash Treasury securities and selling Treasury futures to pocket the basis spread. The leverage in the basis trade amplifies both the demand for overnight repo funding, because hedge funds must finance their cash Treasury positions overnight, and the vulnerability of repo market stability, because when basis trade positions unwind under margin pressure, the hedge funds that are simultaneously cash borrowers in the repo market become forced sellers of Treasury securities, compressing the collateral value that repo lenders hold. The March 2026 episode, when every point on the yield curve went negative simultaneously with equity losses breaking the 60-40 portfolio correlation, was driven in part by basis trade unwind. The FSB report noted specifically that the April 11th tariff announcement had a slightly negative impact on clients' ability to meet margin calls in repo markets. On a day when the Fed is holding its April meeting, the Treasury General Account is near its seasonal peak, the RMP purchases ended 13 days ago, Warsh is being confirmed tomorrow, and every money market rate model is watching the SOFR IORB spread for signs of stress. The specific actors in the system who matter most are not the retail investors watching the S&P 500 close at all-time highs, or the financial television anchors covering the FOMC statement language for the word stagflation. They are the approximately 700 banks and primary dealers that participate in the overnight repo market, and the 18 primary dealers that determine how much of the daily $1.3 trillion in tri-party repo they are willing to fund on a given Tuesday morning in late April. Those actors are making a specific calculation today that they did not make last Tuesday or last month. They are calculating the reserve buffer remaining after the April tax drain, the uncertainty created by the imminent change in Fed leadership, the concentration risk in repo collateral documented by the FSB, the inelasticity of domestic bank lending in repo identified by the Dallas Fed, and the specific calendar reality that the next scheduled FOMC meeting is not until June, meaning that if reserve conditions tighten further in May, there is no scheduled meeting at which the Fed can formally adjust its operating parameters. The Fed could conduct emergency operations between meetings. It has done so before, but the need to do so outside a scheduled meeting is itself a signal of stress that every market participant would interpret with alarm. The liquidity trap that this specific Tuesday morning describes is not a trap in the 1930s Keynesian sense of a situation where monetary policy loses effectiveness because everyone is holding cash. It is a trap in the 2026 plumbing sense, a situation where the structural conditions for overnight lending tightness are present simultaneously, and the mechanism through which that tightness would normally be relieved, the Fed's reserve management purchases, has just been suspended. The trap closes when every institution that would normally lend excess reserves into the overnight market decides simultaneously that its own precautionary reserve needs, its regulatory liquidity requirements, and its uncertainty about the forthcoming balance sheet framework under Warsh make it more rational to hold the reserve than to lend it. When everyone holds simultaneously, the collective result is what happened on September 16, 2019, when SOFR spiked 300 basis points. When every bank makes the individually rational decision to hold its reserves rather than lend them into the overnight market, the individually rational decisions produce a collectively irrational outcome, a system-wide shortage of overnight funding that requires the lender of last resort to step in with whatever volume is necessary to restore stability. The lender of last resort is the Fed. The Fed will step in if needed. The SRF exists for precisely this purpose. The $100 billion per day interventions of September 2019 were the demonstration that the Fed can and will provide whatever liquidity the system needs to function. The architecture is robust enough to prevent the scenario from becoming a catastrophic market failure. What it cannot prevent is the signal. When the SRF is tapped for tens of billions of dollars on a non-quarter end Tuesday in late April while the FOMC is meeting and the incoming Fed chair's confirmation vote is tomorrow, the signal is not that the system is functioning smoothly. The signal is that the private lending that is supposed to provide the marginal liquidity the system needs is not providing it, and the official backstop is absorbing the gap. That signal, when it becomes visible in the SOFR data published the next morning, is the data point that every money market analyst, every treasurer at every major financial institution, and every risk manager at every primary dealer reads first. The broader economy does not feel this today. The S&P 500 is within striking distance of all-time highs. The FOMC will hold rates unchanged and issue a statement that describes the economy as expanding at a solid pace. Powell will give a press conference. Warsh will be confirmed by the Senate Banking Committee. The markets will discuss whether the Fed's language about the Iran war is hardened. The financial press will count the number of times the word stagflation appears in the statement or the press conference. None of this is wrong. All of this is real. But underneath all of it, in the overnight repo market that processes $1.3 trillion of transactions before most Americans have finished their morning coffee, the specific dynamic that preceded the September 2019 spike is operating again. Reserve conditions are tighter than they were 60 days ago. The buffer built by the RMP purchases is being consumed by the April tax drain. The mechanism that was providing $40 billion per month of support ended 13 days ago. The institutional uncertainty about the forthcoming Fed operating framework is at the highest level since the transition from Bernanke to Yellen in 2014. The federal home loan banks, which account for over 90% of federal funds market lending and are the crucial marginal lenders in the overnight market, are adjusting their allocation between federal funds lending and repo based on the rate spread between the two. When repo rates are higher than federal funds rates, FHLBs move toward repo, tightening the federal funds market. When both are elevated, the FHLBs are effectively determining the marginal cost of overnight bank funding for the entire system. They are not banks. They are not regulated as banks. They do not hold reserves at the Fed. They are the pivotal institution in the most important daily market in the financial system, and their allocation decisions are driven by rate spreads, not by any mandate to preserve systemic liquidity. The Dallas Fed researchers who documented this dynamic explicitly described it as a structural vulnerability. The system becomes reliant on a less elastic source of marginal liquidity. As the marginal lender shifts from money funds to FHLBs to banks, when the FHLBs pull back, the system moves to banks as marginal lenders. When banks are inelastic lenders, as the Dallas Fed demonstrated with the $89,000 profit calculation on a $100 million repo in a 32 basis point spike environment, the funding stress propagates rather than absorbs. Today, April 28th, 2026, is not September 16th, 2019. The reserves buffer is larger. The SRF backstop is more robust. The Fed's operational toolkit is more developed. Jerome Powell's last meeting is not a crisis event, but it is the specific day on which the convergence of forces that produced the September 2019 spike and the October and December 2025 near spikes are simultaneously operating at their most concentrated. The April tax drain, the end of RMP purchases, the Warsh confirmation, the Powell departure, the FOMC meeting week positioning, the basis trade vulnerability, the stablecoin reserve demand documented by the New York Fed, the FSB's 70% zero haircut exposure in bilateral repo, the SOFR IORB spread that has been drifting steadily higher for months. Each of these forces is manageable in isolation. Together, on this specific Tuesday, they describe the architecture of a liquidity trap that has not yet closed but is narrowing in real time. The specific number to watch is not the FOMC statement language. It is tomorrow morning's SOFR print. If SOFR tomorrow is running meaningfully above IORB, the SRF will absorb the gap. If the SRF absorbs a record amount on a non-quarter end day during an FOMC meeting week, the money market signal is not ambiguous. It is the system telling you, in the only language it speaks, that the transition from one Fed chair to another, in the context of an Iran war and an April tax drain and a structural repo market vulnerable to concentration risk and zero haircut bilateral lending, has arrived at a point where the private lending that is supposed to fund the system's daily heartbeat has stepped back, and the official backstop has stepped forward. The lender of last resort always steps forward when it must. The question that every money market professional is watching today is how many times it must step forward before the new chair of the Federal Reserve makes the decision about the size and scope of the balance sheet that will determine how often and at what volume the stepping forward will be required in the years ahead. Kevin Warsh wants a smaller balance sheet. The system, on this specific Tuesday, is demonstrating why the path to a smaller balance sheet runs directly through the exact stress events that a large balance sheet was designed to prevent. Jerome Powell opens his last FOMC meeting this morning as the Treasury General Account approaches $1 trillion. The reserve buffer he built is being consumed. The mechanism he used to build it ended 13 days ago. His successor is being confirmed tomorrow. And the repo market, which processes $1.3 trillion in overnight loans every single day, is watching every single one of those facts simultaneously and making the lending decision that each fact influences in exactly the same direction. That direction is not lending, it is holding. It is precautionary. It is the individually rational response to a collectively dangerous moment. And the institution designed to step in when that moment arrives opens for business at 8:30 every morning at Constitution Avenue in Washington, D.C. And right now, on the first day of Jerome Powell's last meeting, it is watching the SOFR data with the same attention that every primary dealer in New York is watching it. Tomorrow morning's print will tell you whether the watching was warranted.